All right. Good afternoon and welcome, everyone. We are so excited to relaunch our webinar series. It's our very first webinar series of the year. Thank you, everyone, for joining. I am Zuli Marabona, Senior Vice President with KWPMC. Again, most importantly, I am your co-host today. After taking a brief pause, we are ready to relaunch our webinar series for the year. Today's session is probably the most important one because we're going to be talking about the budget season. And I'm sure we would all agree that this budget season is probably as hot as our weather outside. I am serious. It is hot, hot, hot. These are very critical months right now. And we are here with a very expert panel. I can't wait to introduce these ladies today. To talk about budget season. Both condominiums and HOAs are in the middle of this process right now, and it is filled with questions, uncertainties, and lots of questions with regards to what process we're following with the changes, complexities, and many unknowns. We definitely want to go over what the next steps are as far as capital projects, reserves, insurance, and what role your management team plays, what role your association boards play, and beyond. A few housekeeping items we want to make sure that we go over with you. For those of you that introduced your questions in advance, thank you so much. We'll do our very best to answer those questions before or throughout the session. But if you have questions throughout the session, please introduce those throughout our Q&A chat. And with that, I'm going to go ahead and turn it over to my co-host, Alex Martin, who's going to introduce our panel of experts and kick off our session today. Alex, what do you say? Are you ready?
I'm ready. Good afternoon, everyone. Wow, as you were speaking, I'm looking at all the names here. So many familiar names and faces. I could put the face with the name here. So I thank everyone. Yeah, I thank everyone for joining us today. Because today, by popular demand, we have Nicole Johnson, and she is a partner at Hafer CPAs and Consultants. And we have Roxana, our one and only Roxana, who's their Executive Vice President of Finance. Nicole, could you give a little bit of your background so everyone knows who you are?
Sure, absolutely. As you said, I'm Nicole Johnson with Hafer Company CPAs. We concentrate in the area of HOAs, condominiums, developer turnovers. We do over 1,000 associations in the state of Florida. I also sit on the board for the FICPA, the Florida Institute of Certified Public Accountants. In the industry, the CIRA industry, CIRA, Common Interest Realty Associations. We do taxes, budgeting, help associations with their audits, reviews, compilations. One thing we don't do is we don't do any type of bookkeeping or oversight like that. That's what we have our professional management companies, and that's why KW comes into the picture.
Amazing. Thank you, Nicole. Roxana?
Hi, good afternoon, everyone. I'm an Executive Vice President of Financial Services for KWPMC, and I've been with the company 16 years. But many years ago, before I started, I'm a CPA. I started my career as an auditor, very similar to Nicole. That's how we met right at the beginning of my career, actually at KW 16 years ago. And very happy to be on today's panel. It's been like 3 years in a row, Nicole, I think.
Yes.
That we've done this. It's been very successful, I think. And it's really great timing to talk about budgets. In KW, we do start talking about it back in April, May. Wow. So this is a great topic. I know there's not many people out there that can say that they really enjoy budgeting, but we do. I do, definitely. It is kind of a great time for us to shine as a company. We involve all aspects, all departments within our corporate office. And we're right now in the mix of it. So this is a great time. We welcome everyone that's logged into the webinar. Some names I see that Alex recognizes. And so please, we're here to answer your questions.
We have a full house. I'm looking at everyone's coming in. It's a lot of familiar. Unbelievable.
Yes, it's very exciting to see.
Yeah, really nice to see. Thank you, everyone, for joining us today. Roxana, I'm going to start with you. I know part of our standards of excellence are out to the outside, which is our SOEs, what the world sees as KPIs. We start really early in the year, right, with the budgets, because we want to get to that mid-year financial review. We want to get ahead of the game. be proactive, because if you start doing it now, it's late. If you started in September, you're late. I mean, in our world, right? Especially we're founded by CPAs. Can you just give a little bit of that background, how the process starts and what you do?
Yes. So, I thought about this question. So you did prep me at least on one question, which is that one. And the answer is it's every month, actually, because your variances in your income statement between your actuals to budget will let you know how well did you do budgeting for this current year. And that's a stepping stone, believe it or not, to 2025, right? Because the things that you missed this year, let's take a note of that. And honestly, variances, I know, may take a little bit of time, but if you think about just the trends, if you do it well for 3 months into the year, you kind of already foresee what's going to happen month over month. And I always, recommend having that variance analysis open with our managers. So I would say it is a monthly process, if you will, but we kick it off at KW in June. So we come out and we start talking to our managers about what is the timeline to approving a budget. And the way we do it is that we work ourselves back from the goal date. November 1st for our company is the date that we strive to meet for all of our associations that have a calendar year. And the reason for that is that most people go on vacation somewhere between the middle to end of November, and then the holidays start. To one, give attention to a budget. Our budgets are becoming more complicated. We've seen double-digit increases unlike any other time in the last 3 years, right, Nicole? It used to be the nominal 3 to 5. Now we're talking 10 to 20, possibly 25, because of the probably things that we're going to talk about in this webinar, because it's still affecting our industry. So November 1st, walk ourselves back June, which seems pretty early, but really we need time to put together. We have a proprietary budget template that we use at KW, and then we send that with historical data in it. Then we ask our managers to populate it with their district managers, their supervisor, and then it comes back to accounting. So in our process, we do involve all aspects of our corporate support. We also ask our recruiting team to give an opinion as to the labor analysis in our different areas. We're in the full state of Florida, so they go by region and they give us that feedback. So it takes us time to digest all of that information that comes down to a few lines in the budget. And now we've been talking, I think, for a few years now about reserves. It's not that easy anymore, and we have to be careful. And there's a step-up basis to all of our budgets. We started 2 years ago. I think it was the first webinar we were talking about SIRS, Structural Integrity Reserve Studies. I think the law had just started, and we started talking about that and how it's adding to the conversation that boards have to make decisions, and insurance. So that's just opened up a different level of conversation. And all of our associations have to go up to their professionals, not only as their professional management company, but also insurance agents and reserve or engineering professionals. So with all that said, we as KW try to issue a first good draft. See, we take the point of view that it's our job to do the budget. It is our job, not only because we have to live by it, we're your management company, we need to know and stand by the numbers that we put in there that are either a measurement of our performance or it's something that we need to work towards as a goal. So we give you a good draft as a board sometime in the 1st to 2nd week of September. So that way it gives the board time to digest the information and also hold town hall meetings. It's good to inform the owners, and to do that between September and October 15th, basically, is our drop, the range that we recommend, about a month, 4 to 5 weeks, really. And then we ask the actual approval of the mail out of the budget to get approved by the 1st. So there's a lot that goes into a budget that starting in June, seems rushed to me, actually, but we do give attention to that variance analysis every month.
Thank you, Roxana. Alex, do you mind if I jump in?
Jump in, Julie. Go ahead.
Okay, thank you. Because thank you everyone that's participating, because the questions have started to come in. And surplus seems to be one of the questions that are some of the questions that are coming in. So budget surplus, Lynn is asking Roxana, budget surplus, my association has a large expected 24 surplus, largely due to favorable insurance variance and delayed landscape projects. The owners have already approved a rollover to the 2025 budget. Can the association allocate a portion of the surplus to offset fees in the 2025 operating budget and a portion to 2025 reserve funding?
Good question. What do you think, Nicole and Roxana?
You want to take it first?
So, from an accounting standpoint, from the auditor standpoint, I never recommend that. A couple things. First of all, unless you have an enormous amount of surplus, over 6-8 months worth of operating, that's a different story. Most of my associations do not have that. So first of all, if they're not fully funding reserves, I never recommend that, because you need that money for capital projects that are coming or unexpected expenses. So if you're in the position that you have 2 to 3 months worth of operating, I do not recommend it. If you have over that, you are able to do that. It is a board's decision, but there's a few things you need to look at. What are you projecting in the next 5 to 10 years where you think your operating expenses are going? Because you don't want to give money back or put it to the next year's budget, and then 2 years down the road, you're raising the dues 30% because you've given back money that should have never been put into the budget. Also looking at it from a tax perspective, are you filing an 1120H or an 1120? An 1120 tax return, that surplus is taxable. So you want to make sure you're doing that vote at year end to roll that surplus over. But then the IRS is going to look at, did you actually put it to the next year's budget? So from us as auditors, I haven't seen any of my associations that I've done, over 1,000 of them, that I would have any recommendation using that to offset the next dues. You're giving it to your owners because it's still sitting in equity. So if a project comes due, the owners are still benefiting from it. It's just they're not using it to reduce the dues or use it for future. They're using it through equity.
Yeah, and I cannot agree more. Our recommendation to our boards is always not to give back a credit. Basically, you're giving a credit to your owners for normal operating expenses. And what happens with that, if you do, there's a yo-yo effect. I'm going to give you 5% back, but next year, because expenses continuously go up, there's inflation, there's contracts, they're going to go up, utilities, they're going up, and now reserves. Next year's increase will take back the 5% that we gave you, plus take an additional 5. So now you decreased someone's fees unnecessarily. Then the next year you're gonna double the increase.
Right.
So
you're giving a false sense to them. You're exactly right that the fee, wow, our fees are coming down. They're not realizing that in the future years, they're going to go up even more. So my associations that have never given the surplus back, I'm seeing where their budget doesn't go up as much. They're keeping it consistent with the raises because they're keeping that in equity for future projects.
And even to your point, Nicole, where you said, you know, any in excess of like a large amount, 5 years or 5 or 6 months worth of extra surplus, even at that point, we recommend that you give it back in the form of a capital improvement, not
Agreed.
directly as a credit to even operating fees.
That's exactly how I would go about doing it. Same
or even better, put into reserves, right? You could roll it into reserves.
Absolutely.
Always a good choice.
Keep it to the association.
Yeah, and something in the statute, because I've often asked by our clients, so where's that in the statute? The only mention in the statute is that you need to speak about a deficit or a surplus during this time, during the budget time. It does not tell you what is a surplus, how to calculate it. It just says that you need to talk about it during this time of the budget. So in Nicole's, example, if you have 5 months, but you've, as a board, decided to retain it and not give it back, you need to let your owners know and
Correct.
let them know why. We're in a hurricane-prone state. We have unforeseen expenses that may come up, and we don't want to come back to you, owner, on a special assessment we already have the surplus that can help us pivot as an association to meet those demands of unforeseen expenses.
And do you have many associations that you handle that have 5 to 8 month worth of operating? No.
No, I would say that we've done a really hard job of having those 2 months. But it's rare to see any with 3 or 4 months.
Us either. I'm not seeing that.
Okay, great. So most of the questions so far were around surplus. We have a few more questions coming in, but I'm going to save those. I'm going to go back to you, Alex, so we can continue on. I know we have a lot of questions that were submitted in advance around SIRS, of course, and reserves. So we're going to do our best to answer some of those. So Alex, take it away.
So everybody take a moment and pencil in the calendar October 16th, because we're going to talk about SIRS. And we have some amazing people going to join as panelists October 16th. So take this moment and just block that time. It's going to be amazing. But I know SIRS this year is affecting the budget. So one of the, you know, the legislative changes, you know, it's really impacting the condo associations right now. Can you explain some of the budgeting requirements and deadlines that condos have to meet and when, and how that is affecting the budget process?
Sure. I can start with some of them and then I can have Roxana join in. So one of the things we've done a lot of budget meetings, but educating people before they get into the budget is making sure they meet all these deadlines. The first one is the Sears is required to be in your 2025 budget. So the report that has been issued to you must be shown on this year's budget. You still have the opportunity to allow the membership to waive or partially fund the Sears. However, that budget must be approved by year end. It is crucial. I have some associations that they approve their budget always at the next year. The problem with that is if you approve your budget in January, you are now required to fully fund those Sears in the new law. So the most important thing is getting your budget completed and approved by December 31st, 2024. As long as you've done that, you have the ability now to waive or partially fund those Sears. I have a lot of association that I'm saying all you're doing is pushing that down the road. Because even if you fund a portion of it, it's going to have less impact in future years for your budget. Because in your 2026 budget, you must fully fund those. So there's no exception moving forward. So if you're just doing it and delaying it by 1 year, next year's impact is going to be crucial because it's going to be even more. So what we're trying to do is tell our associations, even if you do partial or something towards it, and it all depends on the reserve companies when you had these studies done, how they allocated from the non-Sears into your Sears, where you're going to be at. So the most important is how that allocation was done. What are you seeing, Roxana, with those allocations?
It's so important to have it in mind to fully fund Sears, right? Because similar to what we were talking about, the surplus, it catches up with an association. You eventually have to pay for it. And in simple math, if you have to put in $500,000 for the structural integrity components, and you cut that in half this year for 2025, in 2026, you will see not only the 250,000 that you cut, plus the 500,000, potentially even more, because there is an inflation factor. If we want to really do this the right way, you have to update that study too, because costs are going up. And, you know, when you look at Miami, downtown, Brickell, what do we see? We see cranes. Developers are in town. They're all over the state. And that just drives up costs. And that's just particular to us, right? And so it's not going to get cheaper if you delay it for a year. So we are recommending to exactly what you're saying, Nicole, to fully fund now. And there's just a lot of conversation as to how they're going to do that. Straight through the assessments to me makes more sense because then you establish that basis of fees for an owner. Because we don't want to play with owners' finances. This is what it costs now to live in this condominium. And from this point on, this is the base year, including the structural integrity reserve study.
Amazing. Frankie, you beat me to a question here because that was my next question that was coming up. Do How does Sears affect HOAs?
They don't.
They don't.
They don't. They are
They
not
don't have-
required to have that. There is really, from an assets point of view, they don't really have what is required for a condominium, the high rise, the vertical, assets. If anything, they have a clubhouse, they have a guardhouse, so those are not required. They're typically not 3 stories or higher, and it's
Right.
not under a condominium.
And most
statutory
HOAs, a lot of
requirement.
ours that we do are non-statutory, where they're not even statutory reserves. And they didn't put that into law, I believe, because there's less risk in an HOA. It's a lot of them are homes where they're not going to have a collapse like Surfside. So there's less risk with them not having to fully fund.
Yeah, and for the board members that might have joined us, the participants that do live in an HOA, that you're on your board, that is very key during this budget season to understand if you have statutory reserves or what is called voluntary reserves.
Right.
So at least once a year, I do get that question and I find and I dig into, wait, are you statutory? Do we have to comply with all of the rules and statutory methods? And it is going back to how the association was created by the developer with the budgets. Was there a membership vote to even have statutory reserves if the developer did not, start them? So.
And I have some HOAs where they've never had anything done, and then they come to us and have us do an audit one year, and we ask them, and nobody has any idea.
I know.
So we always tell them, go to your attorney, ask your attorney what their advice is if you don't know if it's ever been voted on and where you're at.
There's a question that popped up that as you were speaking about 2 stories, I was thinking the same thing. Paulina, you asked the same question I had in my mind. If an HOA's amenities are above 3 floors, do you now need a Sears? Do you have like a 3rd floor structure? That's a great question.
Oh, that's a good question. We have a property that we manage, and it's in downtown, or actually Brickell area, and they have a commercial association. But the commercial association is tasked with maintaining a parking garage that is only 2-story, but above it is the residential. So are they required to maintain the parking garage? They got a legal opinion and they said, yes, it is a Sears park.
Interesting.
But
yeah, Cindy has the same question.
Yeah, to the point is like, you do have to involve your attorney at that point.
Absolutely.
You would need that professional to give you that opinion.
On
I'm
the
trying to get everyone here because the questions are coming in. Cindy had the same question. How about commercial associations, right? Is this a Sears requirement? So
it is if it's 718. So you could be a commercial 718 condominium, commercial condominium.
So I think it's understanding the documents, right? And making sure that you have that clarification. And Alex, we also have some questions coming in around this same topic, but on the reserve side. And it's really clarification on the pooling method versus the straight line. And can the pooling method be used for the Sears reserve?
Yes, I think at the beginning there was a little bit of confusion, right, Nicole? I think the language confused me. It sounded very much like straight line. And in fact, we do, as part of our business, we have a consulting arm that helps developers create budgets. And in that, there was a consultant engagement to create the budget, and it was the first Sears. They did it on a straight line for a developer. But after that, there's been a little bit more clarification. I know the engineers are getting more versed on the calculation, and pooling is allowed. And that's what we're seeing predominantly, is just pooling method.
Yes, and I've done a few seminars where I've heard the attorneys state that it is allowed from some seminars, because we need to know that from the audit perspective if it's allowed by the state. And someone did ask, we'll make sure we're clear because we're using all these acronyms. SIRS is SIRS, the Structural Integrity Reserve Studies. Make sure everybody knows that.
Yes.
We're so used to using that language for people that are on there that don't understand it.
Well, for some of us, depending on our age, we might remember Sears. That's why.
Store. That's right.
That definitely, I know that store.
we all knew that store back in the day. So we just dated. I just dated myself. Sorry. So yes. All right. So these reserve studies. What are you seeing in these reserve studies? There's a lot of curiosity out there, and people are asking questions like, "Do you just now typically go get your normal reserve study? Do you need an engineer involved in your reserve study because of SIRS? What is the best practice? What are you seeing out there?"
So what I see is that you do need two, basically. There is how I'm seeing the information reporting coming in is literally two PDFs. One is the Structural Integrity Reserve Study, and the other one is all other components. So there is a difference between the two, and it's all laid out in the statute as to what are the components that are coming that are now been defined as structural components. That's in one of the studies, and the other is the other components. So there are two numbers, and the way that we're addressing that here internally is that there are two numbers now on your budget there, so that it's very clear that this is what you're funding to your structural integrity reserves or components, and these are the other components. And even how we're going to be reporting that on a monthly basis, there will now be a separation between, at least in our balance sheet and financials, structural versus non-structural components. So that's very clear what monies go in for structural, because per statute, once the money goes in for those structural components, it can only be used for those structural components. And you must fully fund right after 2025. So you do need establishing in 2024 for 25. So you do need to have visibility and ease of knowing what has gone in and what has gone out from those funds.
Alex, what do you think if we maybe segue away from this topic a little bit and maybe jump into, if we have a little bit of time at the end of the session, back into the SIRS topic and start, we have a lot of questions just on reserve. So maybe we jump into reserve questions and some other topics that have come up.
So Jake has a great question here. Actually, someone else submitted the same question, Jake. We have historically revised our reserve study every 3 years. Are we required to follow a different schedule now that SIRS are part of the planning picture?
Are they a condo or are they an HOA? Are they condo?
Let's say condo for now. Jake, I'll wait for you to respond, but let's go for condo now because I know condo is usually 3 stories or higher.
Right. So what I would make sure is the report that they had done 3 years ago is in compliance with what they're required to have for the SIRS. So if that report is in compliance with what is supposed to be for the SIRS, then they wouldn't need that. But I would find it unusual that it is, because if it was done 3 years ago, they might not have everything up to date. So I would be reaching out to the reserve company to make sure that this is in compliance with the SIRS for their 2025 budget.
And I think there's two things. There's the full reserve study where someone's coming, an engineer's walking the property and really looking and investigating what has been replaced, what is the remaining life of all your assets, and walking the property with either a board liaison, the manager, versus an update to the reserve study. And what we recommend is having an update to your reserve studies every year because of what I said earlier, which costs are going up, inflation, and the fact that we have developers in town driving the cost up. So updates every year. You can negotiate that at the beginning when you engage the engineering firm, and they should give you a discount. We definitely get discounts for our associations because we are going to engage them every year. Just an update and then a full reserve study every 3 years.
Great. Liz has a question here. Can the board pick and choose which components to fund in the reserve study for 2025?
Can the board choose?
So
they can choose.
Create their own schedule.
They basically have to break it out. So they have the SIRS and the non-SIRS, and then they would need the membership vote to not fund either one of them for the 25 budget, then 26 budget, the SERS has to be fully funded. They cannot pick and choose. And then the non-SEERs, they would need the membership vote to continue to do that year after year.
Yeah, that's a very good question because I have been asked by our boards, but we don't have to fund the non-structural anymore. I'm like, no, you still fall under the existing statute, which governs those components. Correct. And the definition of reserve components has not been negated. It is still in the statute. They've just added wording about the structural integrity reserve study. So the integrity of the wording and what we've been doing for years still stays. You still have to have a membership vote if you are going to fund less than whatever fully funding is for other components outside of structural. That's a good question.
It is.
And I see why it's confusing, right? So
it is very confusing. And one thing is I try to tell my boards is it's going to put a lot of condos now on the same playing field because now everybody's going to have to fund these SERS. And then the non-SERS, the board membership can make that decision. But what I'm seeing is my associations are saying, I want to fund it all because we want to make sure we're keeping our property values and resale values because people are really looking at that now. Are you funding what is going to be required to make sure this association is financially stable? I don't want to be hit with these large assessments. So you're going to see boards now going to be wanting to fund both pots.
That is such a great point. And I've also noticed that in the MLS, now it says, and SERS approved or SERS done. So it's a very big topic. It really has changed our industry dramatically in many ways.
That's interesting about the MLS. Yes. Yeah, very interesting.
Yeah, they're getting ahead of it. I've noticed that. I had a discussion with a board president this morning about that, and everyone wants to get ahead of it because, you know, a healthy building has sales. A building has
absolutely.
Yeah.
Yeah. So it's a good question. Ron, you had a good question. So how much involvement do you see, do boards or finance committees typically have in preparing the budget?
Well, from my perspective, it's definitely increased.
Okay.
Because the conversations are becoming a little more difficult. We've definitely seen a change in management. We've been honored to take on what used to be self-managed associations because to navigate statute and navigate the reserves, it's getting more difficult. You do need professional management company to help. And in our organization, I'm not the expert in engineering. We definitely have an engineering department that I could go down the office and ask if I have a question about reading or dissecting a reserve study that was prepared by an engineer. So,
I think too, one of the things I've seen in just our side of it is we're seeing a lot of associations starting to get away from the self-managed and going into professional management companies because there's so much involvement that they realize they need those resources. So companies like KW, they're saying we need them because KW has such a vast amount of resources to help them through this whole process. As a board member, I would never want to be on my board without having a professional management company right now with everything that's changed in the laws, HOA and condo. There is so much that needs to be done.
I get calls every day, Nicole, from self-management properties that want professional management. Especially now, there's a law that's kicking in that even D&O's insurance will not cover a board member and they could be sued individually for bad decisions, right? Am I correct?
To increase liability and risk.
Yeah.
Right?
So I wouldn't take on that responsibility. I bring professional management to take on all that responsibility.
Me too. I
So,
completely
you know what
agree.
I've seen too, that the association's seeking professionals within their communities. So we're seeing more CPAs on the board to can make decisions. An engineer, if there's an engineer, they try to, recruit that engineer to be on the board so that it couples with our resources.
Those are the perfect individuals to have on a committee and a board to help, to be your partner, in protecting your home.
Yeah.
So we have a question here from Elizabeth. So we're going to talk a little bit about AR. Elizabeth, thank you for your question. She wants explain the role in the budget for AR accounts. We carry AR every month. to about a third of the monthly operating expenses.
And she had another question here, which is good. What is the appropriate inflation
factor? Yes.
So you may want to just include that in your response.
Yes, yes.
So if I understand the question is about like delinquencies.
Yes.
And that they're carrying some delinquencies and what to do about it.
And what to do about
in their budget. So one, I mean, just from a practicality, and we're measuring this every month, because the fees have gone up, we track the trends for the last 6 months and we're paying attention. Is the climate, increasing in delinquencies just because we're increasing double digits in assessments. So we want to always keep tab of that. But aside from that, the budget, it is a number that is actually calculated by the accountants. And the reason why we do that is that we're looking to see who among the units have not paid 2 months or more. Early on, when I joined the industry, this was something that I learned really early. If they're not paying the association, they're not paying the mortgage. So you have a defining time. 2 months historically has proven correct. If they do not pay after 2 months, you have a problem. So how I measure bad debt is what we do as KW is that we look at any of our owners that are not paying 60 days or beyond 90 days. And then we literally count them and find out how much of that is the percentage as a percentage of the total number of units. Then we question whether or not the unit is in some legal status, meaning we've already turned it over to a collection attorney. Is there bankruptcy? You should count that unit as being delinquent and not paying your association for a whole year, the following year. Where are we with collection process, right? If they are in the hands of the attorney, there is no guarantee that they're going to pay the attorney in any given month in the following year. So we also add those units to the calculation of basically what you're saying with the bad debt is who's not going to pay you. And unfortunately, everybody else has to pick up for those that do not pay because the landscaper still has to be paid 100% of their service. We have to pay insurance 100%. So we have to build in that cushion of the bad debt based on factual information and just seeing some statistics about your delinquency.
Right. And from a layman's term, if you don't build that into your budget, you're going to be short cash wise to pay your bills. Because if not everybody's paying and you put the budget in like everybody is, you're not going to have enough to make it to year end. That's the main purpose of putting that into your budget.
So an extension to building a cushion, this is a two-part question, and you both touched on that early on when we were talking about a surplus and what to do with that surplus at the end of the year, which is really the reverse of that. There's another question by Aaron. Thank you for the question is, do you recommend your association operating budget contain a line item for emergent expenses or a contingency fund? So if so, what percentage of the overall budget do you recommend? And also, should we set aside unexpected costs that come up throughout the year? So one, how much operating surplus should we have set aside? And two, what, if anything, should we be building into the budget? Which I think is a great question as well.
Yeah. It's a great question. I never recommend a percentage. So, yes. Right, Roxana, I don't like that word when people say, yes.
Yeah. Yeah. I think from my perspective, it's more about let's budget correctly. If you have a plumbing issue and you have leaks because you're a mature association, budget accordingly. We put in historical data into the budget worksheet. So we're always looking back to see what is the trend and what happened, that provided those numbers. And is it realistic that we expect the same? If we expect the same, that number plus a little bit for inflation. I think that was a little bit earlier, the inflation rate. What is it? We've been putting in 3%. That may change because I know the Fed is going to come out today, maybe lowering Fed fund rates. And so I would say budget properly, be conservative in the area of repair and maintenance, see what your historical trend has been for any given amount. But is there times where our boards want to put in contingencies? They have, but it's not a large number, because what we always try to recommend is that you're giving this to your owners, and they're holding you accountable, where every dollar is going. And you should let them know. If we think that it should go to plumbing, or we think it should go to general repairs, there's some historical value that lets us believe that this is the number. That's what they should know. And again, it's an estimate. When you get into repair and maintenance, it's an estimate. I don't like contingencies. I'd rather know where the funds are going, and to illustrate that to the owners.
Yeah, true accountants don't like contingency because they feel like it's a slush fund. Like the board can put this in and they can use it for whatever they want. And like Roxana said, she made a good point. You should be really going line by line in your budget and have such great estimates that you don't need a large contingency. That would be emergencies, but that shouldn't be. I have some that'll put 100,000 in there. I said, if I was an owner, that's really for you to just use that for whatever. You should be really being able to get down to each line item and see where we're at, especially if you're fully funding reserves.
Correct. Negative or positive, you need to see whatever variances are out there. You want to see what it is so you can track it right and plan for it. Right.
Exactly.
I'm not an accountant, but that's the way my mind works. Right.
And also the recommendation, we were talking about the 2 months of operating expenses, to have that in surplus and retain that, also help you pivot when there are those unforeseen expenses, and be able to pay for those.
Ron has a question here. Does condo associations budgeting for hurricane deductibles as an extra reserve line item?
I've been seeing that trend a little bit more in the last few years, maybe in the last 5 years, but once it's done, you put it into reserves. Actually, that one particular line has to be treated as a straight line. Meaning once whatever is funded there, you cannot touch it, because the idea is to have those funds available for if there is a need for it from an insurance claim.
Right. And it's a non-statutory reserve, like Roxana said. It won't be in your pooling schedule, so it'll be separated out. And if it is needed, it can be used for something other than the deductible.
Okay. Larry has a good question here. If you're a fully funded HOA, but between reserve studies, what percentage would you increase reserve contributions for 2025?
So that's a loaded question.
Yep.
It is a loaded question.
I would need to know the components that you currently have.
As you were speaking, I was reading it. I was trying to think about it. It is very loaded.
Yeah, that's reserves information. Could help.
Yeah, we would need to see the details behind that. That's definitely a loaded question.
Yeah, it is.
All right, here's an easy one, maybe. Can condo boards use maintenance money or maintenance funds to support a recreation committee or other committees?
So can you use association funds for like a social committee,
right,
etc.? Yes. Yes, we do have a lot of lifestyle communities that we manage, that they do have a lot of events, as you know, Suli, that do put away kind of like seed money, kind of to start the season. We do have some seasonality throughout the state in different areas, and we allocate some funds because for the benefit of all, that these events are being held for all association owners. And so they do put away some money. However, the trend is that the social committee will generate events that will also have donations for the events, and that they could be self-sustained. That the money that you're putting in the budget is really a minimal some amount. It's not hundreds of thousands of dollars. We're talking 5,000, 10,000, just to kick it off and make sure that they have the supplies for the events and fluid funds. But outside of that, they're self-sufficient other than that. Would you say the same?
If they're having those other events, that they talk to their accountants, if they're subject to sales tax and all of that in the state of Florida too.
Yes, admission fees. We've gone through that.
Yes.
Sales tax, a very important point. Thank you.
Especially the self-managed ones.
That's why I said donations.
All these taxable events.
Yes. We did get a few investment related questions, which I do want us to cover, but before that, Susan did ask a question on lake maintenance. Well, they recognize that lake maintenance is just a standard maintenance, is an operating item, but should the restoration of shorelines be a reserve or operating line item? And then they mention, Our ponds contractor tells us that the life of a pond absent restoration is about 10 years. And so they're wanting some guidance.
I mean, if you define the deferment of maintenance is over 1 year, it's over 10,000. I would think that is over 10,000. It sounds like a reserve component.
Me too.
Question came in here. What are you seeing as your largest expense in the budget right now? Where are the biggest increases happening?
Besides SIRS, what do you, I mean, I see insurance from the audit perspective.
And payroll and any payroll related service, right? Any labor related service.
Right.
Right.
Where we're still seeing low unemployment rates and, again, just what's in our industry in our vicinity in the state of Florida also drives that, healthy labor market, you know. So the labor analysis that our recruiting team, I think we're all anxious to see it every year when they send it out in the summer to really measure where we are as an association and then where we need to be competitive, to be able to get. And I think, I don't know, Suli and Alex, I think it's the hourly that I think has been a challenge in the last couple of years, and retaining good talent is hard because we're competing now with Chick-fil-A. We're competing with Costco, paying $15, $16, $17 an hour.
Right.
Yeah, I think boards don't realize, like, they're hearing what's going on out there, but they don't realize associations are impacted by the, you know, employees and the increases. It's all over. To get good employees, you have to pay the cost right now. So I agree, Roxanne. I don't think they realize HOAs fall under that too, and condos.
Yes.
They do. Now, Brian has a question here. The staff line is our greatest expense. What kind of percent increase should we budget for 25? How does that?
Well, at least the trend that I'm seeing right now is there is an increase to the gross salary of somewhere between 3 to 5, depending on the category, depending on the position. And I would say somewhere between 7 to 8%. Last year, just across all of our associations, it was about that average.
Okay.
Scott has a question here. I think we answered half of his question. What do you, with your current pooled reserves, do they need to be separated to the SIRS and non-SIRS reserves? Also, do you have to have 2 bank accounts for the reserves?
So yes, it definitely has to be separated out, because one of them is you're never going to be able to vote to waive them. So that has to be separated between the SIRS and the non-SIRS. I don't see anywhere from the legal standpoint that I've read that you have to have separate bank accounts.
I haven't seen it either.
You haven't either. I haven't seen it anywhere in there. A lot of our associations are doing it because they just want it to keep it separate, but I didn't see anywhere where it has to be.
Yeah, and there's already language, and I don't think this has been modified, where for investment purpose, you could actually commingle funds as long as you know what funds have gone in for investment purposes, like if you want a bigger CD, a jumbo CD, things like that. So what we're doing is we are keeping one account, one bank account, but the separations in the counting of the actual fund. So we're gonna literally separate it almost like under reserves. There's 2 sub categories now, which is the structural components and the other components.
And you have at KW, you guys have CPAs, and your accounting department is like being in a CPA firm. So you guys know how to break that out. You're excellent at it, where a lot of these associations do not have that. So they wouldn't know to be able to allocate what interest to what fund. So I think they would be in trouble if they don't have the expertise like you do.
Oh, I could tell you. I know we were founded by CPAs, because what doesn't get
Oh, I know. I do the audits, and I'm like, auditors love it.
We question our CPAs and our accountants question everything down to the penny. I mean, it's unbelievable.
It's
me,
excellent.
you know me, I'm more the like, yeah, it's only 2%. No, it's
I know, we see it from our audit perspective. We'll send out audits and they ask questions on the adjusting entries, and we're like, wow, somebody's actually reading this and looking at it. This is amazing.
Oh, we're reading it.
Oh, we are. Yeah, I get questions all the time.
It's excellent.
Internally. So Yeah.
All right. So
It's a
Alex, how about
positive
we go
thing.
to some of the investment questions? So it's just a few of them, but
Yeah.
so one of the
Because we
questions
got 10
was,
minutes here. So I want to
yes, we're
respect
getting
everybody's
close.
time.
We're getting close. So do you recommend separate investment models for capital reserves versus maintenance funds?
Separate investment models?
Models.
I mean,
Yes. In fact, I was just on a call with the board establishing an investment strategy policy. If you don't have one in your association, I recommend you do one. Because your question is, what do we do for operating? What are we going to do with reserves? And there is a difference. Reserves typically, you don't need the liquidity that you need in operating, because operating, we're talking about the day-to-day, the payment of utilities, insurance, payroll, contracts. You need that to be fluid. So unless you have excess funds that exceed 3 months, then we could start talking about putting those funds away in a longer term, 3, 6 month, maybe even 12 month. But if you're a normal association, about 2-month excess funds, I would recommend securing your funds in an investment vehicle like insured cash sweep, ICS for short. So what that does is that you give the bank a threshold that you want to maintain at all times in your core, what they call the core checking account. And then anything over and above that amount gets swept into an investment vehicle that is composed of money markets with the participating banks. And that keeps your funds very liquid, still earning better than a checking account. Checking accounts are earning next to zero, but the insured cash sweep can earn up to 3.5% for an association. So that's a good, solution to operating funds. Whereas reserves, now you're looking at funds that are considerable. This is a savings, right, for your association. And you could have millions of dollars in there over time that need to be there for future needs. So we work with our banks to kind of measure out when are you going to need those funds. And we put in a treasury plan that involves laddered investment maturities, meaning at any given time, I'm having liquid funds come in, but when we put you into the program, we put you into a 3-month, 6-month, 12-month tiers, so that, again, any given time you're having maturity of funds when you need them. And the amount that we put in there really is dictated by the reserve study.
Great. I think that helps answer, Roxana, a little bit of the questions, because they further expanded on, should we be investing on T-bills, CDs, bonds? So thank you for that. And Alex, I'll turn it over to you. We are on our countdown, almost running out of time this afternoon.
I want to try to get to as much as possible here and answer some of these questions. Realistic, what are you seeing out in the market of increases right now? Is there a range, a percentage that you're seeing, 3 to 5%, 5 to 10, 15 to 20? What are you seeing out there right now? Terry was asking this question.
So right now, some of our we do manage, a range of condominiums. Let me talk about condominiums first. The mature condominiums will see an increase. We haven't tapped into exactly how much, but there will be an increase because of the structural integrity reserve studies. Versus the newer buildings, we do see some relief. Either they're staying flat or a little bit of savings in insurance, because that has changed slightly. I'm not an insurance expert, but I do tap into our partner USI Insurance, and I always question them around this time. So what are you seeing in the market? And it's exactly that. They see some of the newer buildings staying flat to this year on insurance premiums, or slightly better. So that is some alleviation. So typically we were seeing 10 to 15%. I think that's going to drop a little bit, somewhere between 6 to 10%.
I was told today by someone that 9 companies that have come into Florida to insure buildings. So that's alleviating a little bit of the competition, right? And
See some improvement.
some improvement. Wow,
And
there's
the
so many
person that's
questions here.
asking that.
So many great questions.
Yeah, I'm trying. I
So
want to get
many.
as much as so. The person that asked about HOA restaurant break even and
Yes.
because the customer base, we're gonna set up a webinar just with our corporate food and beverage director. We have a food and beverage department, so anybody who's out there wants to ask about restaurants, it's upcoming. We're discussing it. We're looking to do it sometime. I think is it November?
November. We have a
November.
tentative
So
session set for November.
yeah, because we do manage lots of restaurants. We have a lot of employees in restaurant, and I love to answer those lineup. But I want to have our expert on this panel. Can you? Here's a question that came in. Can you pass a budget at the same time have a special assessment to pay for fees that were not included in the budget as special assessment to make up the difference of an approved budget for this coming year?
So a special assessment is supposed to be for unusual item or something comes up. If it's supposed to be in your budget, you shouldn't be special assessing for it. So it sounds like they're doing that to keep the maintenance fees low and then pass a special assessment for the difference. They shouldn't be doing that. It should be all included in their budget. Don't you agree, Roxana? There's
100%, because you're, again, just going back to the concept that it's gonna catch up with you. Those normal day-to-day operations should be in your operating, insurance, payroll, reserves, administrative expenses, contracts, all should be in your normal operating budget. And to Nicole's point, that special assessment should be reserved for those extraordinary expenses. Perhaps you don't have enough funds in the reserves for the roof. You may have to pass a special assessment for that. So it's for extraordinary items, I would say.
And they can always go back, right, and amend their budget. So if they've already approved their budget, they can always go back and amend their budget.
Correct. We had an association that every year they special assess for the insurance, and we kept writing them up in the internal control letter that, well, someone turned them in the state came in, slapped them on the wrist and said that needs to be included in your budget. That's an operating expense. So I agree. That's not a special assessment. Anything that is supposed to be in the operating budget needs to be included.
Maybe along the same lines, because I don't know that anybody's asked, but every year we do get asked, can we pass a special an operating budget that's 15% or higher? And the answer is yes. You're just opening up the board passing a 15+% increase. It's just opening up for the potential of a challenge. And once that challenge and substitute budget is presented to the board can still pass the original budget. And when calculating that 15%, you have to omit the reserves and any extraordinary special projects that you may have built in, one-time expenses built into the budget.
Great. Now we have 2 minutes left here, so I want to give each one of you a minute each. Let's start with Nicole. Nicole, what can you share now? Best practice, what you're seeing out there, what people should be doing, something that's really just on the top of your mind all the time when you meet with somebody. It's like, I got to make sure we implement this, or we do this. What do you?
Any parting words?
I think the most important is stability, financial stability. If you want to make sure that your property is staying up with your values, people are with their resale values, is financial stability. We cannot be worrying about it. And I know people don't want to hear this, what my maintenance fee is. The most important is, are we maintaining the property to make sure it looks the best, that everything is handled, and we'll never have a crisis like Surfside. So I can't say it enough that your financial stability is what is keeping your association where it needs to be. I know that's from an accounting standpoint. We always say, show me the money. Well, that's what people want to see. Are we financially stable when they move into your community?
I would say starting early, budgeting is important. But if you haven't started, do this. Look at your budget, your top 3 expenses. It's what moves the mark. Be very realistic with those expenses. Go line by line and budget based on what you know about your association. Walk your association. An association is there to protect, preserve, and enhance the value that you purchase as an owner into your community. Keep that in mind. To Nicole's point, be realistic, do the right thing for the association and your investment in your association. and grab onto those professionals. I think more than ever, you do need a professional management company. We already come with the CPAs, engineering, recruiting team, and you're going to need them to really pass a good budget for your association.
And to get through these special times that we're going through right now.
Absolutely.
Good point.
Thank you
This
both.
was amazing. Nicole, Roxana, I wish we had more time because so many questions are coming. I'm so sorry we couldn't answer all the questions, but we're gonna have to do this again. But remember, we're back on October 16 for the SIRS. There might be some accounting. So as we're having these discussions, we might have to have the engineer and accounting together because there's some correlation, right? There's some. So on behalf of KWPMC and Hafers, thank you everyone for joining us today. And I look forward to seeing you on October 16th.
Thank you.
Thank you,
Thanks,
everyone.
Allison, Julie. You guys did a great
for your
job.
Everyone.
time.
Thanks, Roxana.
Bye, everyone.
Bye, everyone. Good
Bye,
seeing you.
everybody.
Bye.
Thank you.
Bye.
Bye-bye.